All right. Up next, we have Wayne Marcel, and you're going to be talking about tokenization. And looking forward to this because I think this is one of the most misunderstood areas in blockchain. So thank you, Wayne. And then down.
All right, for those of you watching live or watching the recording, I'm not going to be reading every word on the slide. I created this slide for two purposes, or the slide deck. One of them is going to be just to kind of go over some of the high points, but then I'll also email it to anybody that reaches out and asks for it so you can read through it. But so my name is Wayne Marcel. I work with a company called Bluebird. I do many different things in the space. I have my own consulting agency, but I also work with several different companies. And Bluebird is an asset tokenization company. And one thing I've learned really quickly over the last couple years is that it's very misunderstood. So the point of the talk today is really just to tell you what tokenization is, what it isn't, show you how some use cases it could be used that most people don't think about, and just see that it is not a new asset class. It's not a new crypto. We're not creating a new crypto saying this is the next asset class. It's just a shift in the technology. It's basically taking out old infrastructure, putting in new. You know, you think, back in the day, we had to put new wiring in the homes to wire in electricity. Well, new infrastructure leads to better advances, better technology, and more things can get created from that, and there's more possibilities. So tokenization is that. It's in essence just a shift in technology. All right, okay. All right, let me make sure, okay. All right, so chances are you may already own something, or if not, you soon will. Tokenization is touching all aspects of what you're used to. How many people in here hold stocks? All right, you hold stocks. Chances are that's going to be at some point in time, it's going to be a digitized equity, like we're seeing happen already. So if you have money in a 401k, money in a bank, even your bank deposits, at one point we're seeing that start to happen with certain banks are testing out tokenizing the bank deposits. So instead of having a bank issuing stable coins, they're tokenizing those bank deposits. And so the rails underneath those everyday products are already migrating on chain. So it's not, you may even experience it and hold it and not even know it because the infrastructure is changing underneath, because it's more efficient, it's more transparent. It's just a lot easier to run, and it gives access to a lot more people. If there is a point at one day where the stock market is operating 24/7 like the crypto markets, it's going to be powered by blockchain rails. So like I said, this is an infrastructure story, not a crypto story. So we think back to paper certificates. Then the DTC began immobilizing certificates in the 70s. And now we're going to see the next turn as the same wheel is going to be tokenization. So we already did this once. It's just when we look back, once the technology is adopted, you kind of forget about the steps it took to get there, the challenges it took. Like a lot of what I'm doing right now is educating people. When I go into a boardroom and talk to someone about asset tokenization for maybe some assets they hold or some part of a business they're in, I've got to do this educational process to teach them what tokenization is, what it isn't, and that's what happened. Technology evolves, people adapt, some adapt it early, some adapt it late, but when you're past that full adoption cycle and you look back, it seems like it was easy, but it really wasn't. But we've done it before, and we're going to continue to do it again with utilizing blockchain for asset tokenization. So what it's not a new asset class. A tokenized treasury is still a treasury. Still the same fund. The asset doesn't change. It's not a magic fundraising pill. That's one thing people think. If I just tokenize it, I'll get all this liquidity, all this capital will come in, and that's not the case. You still have to bring your own capital, your own liquidity. Yes, there is the potential for more access globally. Lower the barrier of entry. We've seen some funds that have tokenized that have dropped their barrier of entry from 250,000 to 20,000, or we've seen others that have dropped the minimum barrier of entry from 20,000 to 2,000. So it can definitely help with some of that friction, but it's not a fundraising pill. And you don't just slap a token on it. So real tokenization requires a legal structure, almost always an SPV, to connect the on-chain token to the real-world rights. When you buy a piece, say you buy a piece of real estate that's tokenized, because that's the one that people can pretty much understand the easiest, you don't have access, well, in most cases, unless it's kind of into the framework, you don't have access to that. Say you do like a multi-unit property and you invest in it and it's tokenized, you're not getting access to go live in one of those units or to use the unit occasionally. It's mainly the financial exposure you are getting from that token. So you still have to have, it still requires trust, still requires typically an entity that you have to trust that's gonna act in good faith and hold that entity. And what it actually is, so we're connecting a real world asset to a token with provenance of ownership, legal rights governed by law and powered by code. So when you look at that, it's in essence, like I said before, it is a technology improvement. It's not a new asset class. So the token this is a quote I found that was pretty good when I was doing some research. The token is a claim check. The code is still in the coat room. The coat room is governed by law, not by code. So you still have to operate within the regulatory framework. You're just moving that infrastructure to better technology. All right. So the one sentence definition, tokenization is representing ownership of or rights to a real asset as a digital record on a shared ledger. So it can be issued, transferred, and settled programmatically. So it upgrades record keeping. It definitely upgrades the settlement layer. If you look at what happens in a lot of traditional finance, the settlement layer is where a lot of the friction happens. And in plain language box, SPV, which I mentioned earlier, if you're not familiar with that term and you're watching this, it's a special purpose vehicle. Legal shell company that holds the real asset so the token can clearly represent a claim on it. So these are some misconceptions about tokenization, and both flavors of it are wrong. So crypto narrative, basically, I'll go through these myths. Just for the sake of time. So tokenization makes any asset instantly liquid. That's one of the biggest misconceptions we've seen when it comes to crypto. And that's what you see. I don't know, has anybody seen the articles recently, if you study tokenization, where a lot of the problem, assets are being tokenized, but when you look at the trading that's happening on chain, there's very little movement in the asset. And if you just do a Google search of that the last couple of weeks, you'll see multiple articles about that, and that's a big problem. Not every asset's meant to be traded. Some assets you may hold to where it's gonna earn you a yield, and so you're not gonna trade it, but it's at least issued and traded at least once. Some assets are designed to never be traded, but in essence, just putting something as a token is not gonna bring a lot of investors, and it's not gonna bring you a ton of capital, and you still have to go to market. You still have to have the right market strategy, connection with investors, VCs, any companies that you're looking to invest in. And tokens enable, they don't create. Liquidity comes from investor demand. So if you're taking an asset, if you're, maybe you're trying to fund a business and you're not getting the investors you need, just by simply converting that over to say, okay, I'm gonna represent ownership in the company from a token, from a tokenization standpoint, that's not gonna bring you new investors. You still have to have an investor pool, distribution. So tokenization just enables liquidity potential. It doesn't manufacture buyers. This is the biggest problem we've been dealing with some of the deals we've done in the last couple of years, is that just because you tokenize it doesn't mean that it's actually tokenized. There was one company last year I'd say on paper, on blockchain, we tokenized $32 billion worth of assets, when in essence, only about $2 billion of that has had any market demand that's been traded over the last year. All right, so myth 2, tokenized assets aren't regulated. So we're starting to see this. In essence, you're still falling under the same regulatory framework. With tokenization, actually has a better path to adoption than traditional crypto. And I'm a big proponent for Bitcoin and traditional crypto as well too. Well, some, not all, right? We all know how that goes. But in essence, the SEC has issued its first formal statement on tokenized securities. The Genius Act signed last year. UK FCA authorized the first tokenized UK entity in January. And then Singapore, Dubai, with VARA, they apply existing regulatory frameworks, not carve-outs. They already have existing framework that tokenization falls under. Because like I mentioned, you're not creating a new crypto asset class. You're just moving infrastructure from one place to another, and it just takes some modern improvements to the language of most bills. All right, so the token is the asset. The reality, legal engineering comes first. It's basically giving you, it's giving you the right to a certain level of access or financial exposure to that asset. A token, a digital representation of a legal claim inside a legal structure. Every serious RWA structure sits atop a fund, SPV, or an issuer. So they're still enforced legal rights. There's a registered transfer agent, qualified custodian, named auditors and service providers. So you still have all this legal framework under it. And I'm going to kind of blow through some of these misconceptions because I want to get to kind of telling you more about what we're doing with tokenization now. So another misconception is tokenization is only for crypto native investors. A lot of what we've built and we're seeing built is basically hiding the wire. This is one thing, when I got into crypto 10 years ago, the biggest problem I've said is the user experience. Right? How many people have sent or received digital assets before? All right? If you've done it, you know the problems that come with that. Accidentally sent to the wrong address. Where do your funds go? Gone, right? So, or to a scammer, but even say you mess up when you paste that address, or you try to send one asset to an address, and that address actually is on a different chain. You know, it's a mistake, but it's gone. And so the user experience has to improve. And we've seen over the years, that's what I've been advocating for the last 10 years, but we're starting to see that evolve to where, like, we're seeing even our competitors, which there's so much room in the tokenization space that even our competitors we collaborate with, but we focus on hiding the wires per se in terms of when someone is using a digital asset, whether you're investing in it as a tokenized asset, you're sending, you're receiving. The framework looks like a normal transfer platform outside of crypto and blockchain. You don't even see all the complexities of public wallet addresses. You don't see the complexity of having to link a MetaMask wallet to the website to be able to get that done. So the crypto native part is, a lot of us that got in early, we went through that friction and those issues and the mistakes that have cost us and we've learned from because we want to be early. But we're not going to get true mass user adoption in any aspect of crypto and blockchain technology without making it simple, easy to use, and stop some of those friction points that cause people to stop and walk away. So it's not just for native investors. There's a lot of institutional money that's flowing into this as well, too, because people are realizing tokenization, and I'm probably getting ahead of myself right now, tokenization it benefits in multiple cases. You can't just say there's one main reason why you should create a tokenized asset as opposed to how it's held currently. Think about a multi-billion-dollar fund that they make that fund into a tokenized asset on blockchain. Just the administrative costs they're going to save on administrative costs and settling, just by shaving a few points off, they'll be saving millions, in some cases tens or hundreds of millions of dollars from doing that. So that's why you have everywhere from institutions tokenizing to we've got small entities right now that maybe have maybe they're building a multifamily complex and they're looking to raise capital that way. So myth 5, fractional ownership means anyone can invest with $5. There's still regulation around. There's still a lot of it still involves accredited investors that have, you have to prove you're an accredited investor to invest in these because in essence they're securities, a lot of them. And so it doesn't just mean that the barrier of entry is lower, but we have seen that where funds have dropped their minimums to where invest from $250,000, like I mentioned earlier, to $20,000, or from $20,000 to $2,000. Some products are retail eligible, which means anybody can invest in it. But just like anything else, if to invest in that, if you take blockchain out of the picture and you were to invest in a certain type of business model or business or fund or whatever, and you had to prove you're a accredited investor, you're still going to do it even if it's on chain, even if it's tokenized. All right, smart contracts eliminate all intermediaries. There's still some required intermediaries for some of this in tokenization. What gets automated is coupon distribution payments. Any kind of yield that's normally paid out to investors can be automated. But there's still a lot that is still required to have some intermediaries. I think you'll see a mix of that as this happens. It's just going to make things a lot faster, a lot more efficient, and some of it will get eliminated by smart contracts. So if the platform fails, I'll lose my asset. If it's a well-structured deal, that's not the case. Your legal claim still exists independent of the technology stack. So we've seen chain agnostic by design with Franklin Templeton. They run across 8 chains. You're seeing a lot of this. So even if the platform fails, your asset is still secured by legal framework, and that's the thing about asset tokenization. So it's just a rebranded ICO fundraising gimmick. This was another myth I found. This is the one I probably had to explain the most, that it's really not that. We're not just creating this token out of thin air and say, hey, I'm going to create this token, it's going to have this utility, and we're just going to put it on the market and start trading it. We've seen a lot of that over the years, some good, mostly bad, but that's not what this is. You're just taking, basically it's an asset-backed, legally structured, it's regulated, closer to securitization, with better rails than a 2017 token sale. I invested in a lot of those tokens in 2017. I have a lot of regret from that, but that was it was early. And now it's less about the hype, the speculation. It's how can we utilize this technology to change the world? Now, I'm not saying if someone wants to issue a crypto token, it's necessarily a bad thing. A lot of the advising I do with people that are looking to launch what we call, because you have multiple aspects. You have a utility token, which is a token that is not backed by anything, but it has gives you some sort of access. You have other tokens that have no inherent value, like meme coins, like we've seen, that are just pure speculation. And then we have tokenized assets, which are really just, depending on the asset class, it's just an asset that's represented on chain. But when you look at a utility token, I've told most projects today, they try to use a utility token to fundraise, or they use a utility token just to airdrop to their community. And when you do that, there's only one side of that economic model that happens. And what is it? Is it to buy or to sell? It's mostly to sell, right? So a lot of these utility tokens, they're being launched and they're using the token to fund their early fundraise. And when they do that, you can only do one of two things with that type of model. You can either make your investors happy or you can make your community happy, usually never both. And that's what we see a lot of good projects in crypto over the years that have come and gone because they had really great business model, really great product, but the token itself has caused it because early investors are selling. So that's why it's important to realize that this is different than using tokens as a fundraiser. It's not similar to the ICO. This is actually bringing a lot more legitimacy to what is happening in terms of crypto and blockchain adoption. I like it because, it's not, you've heard the term, a rising tide raises all ships, right? And that's true to a certain extent. The people that are just coming and building stuff to extract value and not contribute anything to crypto, we've seen that happen over the years. Those people are gonna go away, but those that are building real legitimate projects are now gonna get a lot more eyes on it because we're showing real world use cases for this technology. And that's what I saw 10 years ago when I looked at this. I was intrigued by Bitcoin. I realized the problem we had with our financial system, but also realized how many problems could this technology that's behind Bitcoin, how could that technology change the world and fix a lot of the problems we have? So myth number 9, it only makes sense for real estate. Now, real estate is probably one of the easiest ones we've seen that have been tokenized. We've done some projects in Dubai and elsewhere, but there's so many other things that can be tokenized, and I'll get into that here next. We've seen private credit, treasuries, trade finance. I'll tell you about a couple of deals we're working on there, and obviously real estate's big too, but there's so much more than just that. So the myth 10 is the technology is unproven. I think we've seen, I was at an event in Miami in May, Consensus, and the largest booth there was Kinesis, which is a JP Morgan company. JP Morgan's involved, stable coins, $300 billion assets. We're seeing a lot of legitimacy come in. Just over lunch break, I was just catching up on some articles, and I saw it was JP Morgan and a couple other entities that are in the process right now. They're sandboxing, testing tokenized stock right now. And we've heard that for a while, but this was, they're moving forward. It's actually in action, and it's being tested to go live here probably soon. So the technology is very much proven. So just kind of, the myths and misconception in tokenization, there's a lot of overhype on one side, there's a lot of skepticism on the other, and the truth is somewhere in the middle. But hype is exciting, right? Fear, we know that, right? The media plays on fear, right? That gets people emotional. But somewhere in the middle, where it's kind of boring, is where we're starting to see adoption happen. So where the money actually is today, so we're seeing, $33 billion total RWA on chain, and that number varies greatly depending on what you read. As I mentioned earlier, our company last year, we tokenized $32 billion of assets. But really what only gets counted by RWA.xyz, and rightfully so, I tell people the same thing, is until it's actually at least traded or bought one time, it doesn't really count as an asset on chain. Yeah, you can say that, but I can put $1 trillion in value on chain tomorrow. It doesn't mean anything, right? Unless it has some sort of traction. So that's why you see a lot of variation in those numbers that are coming out. 14 billion in private credit. That's one of the biggest categories so far this year. Tokenized treasuries as well, 15 billion. That's the institutional entry point. And then stable coins, I think it's safe to say, has everybody here heard of stable coins? Right? I mean, that was the original RWA, and some rules and regulations over the years have made it a lot better, a lot more trusted. There's some rules around what has to be held in reserves, what type of assets, to make sure that stable coins are secure. So we're going to see a lot more stablecoin adoption, and it's also going to be rivaled by bank deposits being tokenized as well too. So you have multiple types of assets that are flowing. All right. So who's real and what to demonstrate? So tokenized treasuries, MMFs. You guys heard of a little company called BlackRock? Huh? Possibly, right? So BlackRock, 2.5 billion. Franklin Templeton. I know someone that's heading up the digital assets at Franklin Templeton. They've got, right now, yes, their Benji fund, $2 billion suite. Private credit. So private credit is also, we're seeing a lot of tokenization happen with private credit, digital bonds. Digital bonds save a ton of money, quicker settlements. There's just so many reasons why digital bonds are happening. And then payments and deposits, JP Morgan's pretty much leading in the field of that one. Deposit token live for institutional clients on the Base network. So I don't know if you know that was being used by Base. So over the years, and like I said, I'm not going to read everything on the slides because I put this for two purposes. So those of you walking in late, if you want a copy of the slides, I've got my email after this, or connect with me after the talk, and I can email you the slides so you can learn a little bit more about it. So it's dual purpose. But in essence, there's been pilots in the past that have worked, some have worked to a certain extent, some have failed, but a lot of it was we didn't have the amount of institutional adoption we do today. We didn't have, it was just too early. You ever seen businesses that launch and they're just way too early? So that was stuff that was happening back in 2018, 2019, and ironically enough, today we're talking about asset tokenization, but if you were in a talk talking about this in 2018, I'd have been telling you about security tokens, and we'd have been to security token offerings, right, STOs. But a lot's happened. Not everything works, but that's true with all technology, right? Anybody know of a company, think about the internet adoption. Anybody heard of a company called pets.com? Amazing idea. Did they make it? No. Why not? Too early, right? Were people buying a lot of stuff online with their credit card at the time? Not really. Novel idea, amazing idea. Today we look back and say why did that not work? But back then they were just too early. And that's what happens with any technology. So people will tell you, oh, they've tried that, went down that route with tokenization, it didn't work. It was too early. And I think everybody would agree that the timing is right now for this technology to move forward. Like I said, this is why it's different. Regulatory clarity, on-chain money settlement, and institutional distribution and battle-tested rails. So all of those things that have happened have helped pave the way for why asset tokenization is a big thing. So who's leading institutional roll call? So asset managers, I mentioned BlackRock, Franklin Templeton already. Banks like JP Morgan, UBS, Goldman Sachs, sovereign and central banks. Hong Kong's leading the way. And then market infrastructure, DTCC, right? They've got SEC no action letter. New York Stock Exchange got SEC approval. And, so it's happening. We're starting to see adoption. And this is not just for the large institutions, but I know a lot of times over the years when I talk to people about crypto and blockchain technology, a lot of the questions I got asked about that was, why aren't the institutions using this? If this is such a big deal and this technology is so big, why is nobody using it? So now I can go back to those same people and say, hey, but, so that's what we're dealing with today. So the plumbers are replumbing, right? I mean, in essence, if you have old corroded pipes in your building, and you're not just going to put a patch in. You're going to change that whole plumbing infrastructure, and that's what's happening with plumbing in terms of reference to the infrastructure that's powering our financial systems today, institutions, businesses, small, large businesses. But with blockchain technology, even the smaller businesses, the small to medium businesses, they can act and operate as institutions when they have access to global capital, global financial rails. So that's the potential. There's still a lot that needs to happen, but that's what's happening with this. So what problems does tokenization solve for each person? So when you look at the issuer, faster settlement. Faster settlement is really not just for the issuer. We're doing some trade finance deals in South America right now that are helping to get the supplier, the farmer, depending on what type of business it is, getting them paid quicker. When you can speed up settlement, faster settlement, yeah, that's a decent incentive for the large institutions, but it's really a big incentive for those people that are having to finance the gap between when they deliver product to when they get paid, and they're paying predatory interest rates. You can also build in automated compliance for the issuer, lower operational costs, and access to new capital. So that's one of the things that helps the issuer. For the investor, what changes? You can lower the minimums relative to the traditional deal size. That's what I was talking about before. We've actually got, there's a building, actually some of you in the room may know it, there's a building in New Orleans that we're working on tokenizing right now. It used to be a part of the Eiffel Tower in France. You guys know that building? So it's on St. Charles Avenue. So in essence, we're basically tokenizing the building. It's an event center. It does a lot of different things in it. And they already have a membership club. They have 1,000 members in this club already that we did 5 years ago with an NFT, which, you bought the NFT, you're a member. So that was the first time they tried out blockchain technology. And these weren't crypto guys. And now they're tokenizing the building and the revenue that they get for that, for Mardi Gras and other things. And so, yes, it's going to be, we're going to have to get accredited investors to invest, but out of that pool of membership and everybody else in the city that may be interested, they can invest in that building when they tokenize it, and they'll be getting some sort of revenue share quarterly based on the earnings from that building. So, but the average token size, if this was a normal deal size outside of blockchain, what do you think the normal investor would have to kick in for that? About 25K at least? So the minimum investment size is going to be $1,000 per token. So I'm going to split up the value of that building, issue that amount of tokens, and then you can invest. Now, someone can buy multiple tokens. They can buy $25,000 worth of tokens if they want, but you've lowered the barrier of entry. So that's fractional access to previous exclusive assets, 24/7 near instant settlement, real-time transparency, and potential for secondary liquidity, which means if I decide I want to sell my stake in that building, some real estate investments or other investments, you've got to hold them for a period of time. There's no liquidity in that to where if I want to sell it, it's very complex. But with this, you can exit your position at any point. Now, there has to be a demand for it. There has to be a market. So I'm not saying automatically means that if you tokenize it, you can sell it whenever you want, but there's a better chance for secondary liquidity. We kind of talked about some of these numbers earlier, the boring but enormous part, 20 billion annual clearing savings, $100 billion collateral efficiencies we've seen already just from some of those things that have been tokenized by institutions, and 7 billion daily via Kinesis. Average daily transaction volume is what they're seeing run through there. So just think about old infrastructure that would have been running on versus today. That's a ton of money in savings. So this was being tokenized. So we're doing some of these projects in different areas around the world. Agriculture and commodities. Imagine a farmer being able to get access to capital, where they would normally have to go to a bank, and in some of these countries, they're either not getting approved by the bank or they're paying the predatory rates, high interest rates, for a business loan, to where they can get the capital they need to grow their business, invest in infrastructure, by whether it's pre-selling the crop, whether it's a straight loan model, you could do that. Tokenized gold. We're tokenizing anything from mines that are looking to raise capital, that they've already done all the geological surveys, but they need the capital to get that, get that gold or copper or silver, what we're seeing so far, out of the ground. They can either pre-sell that, they can tokenize the pre-mine yield out of there, or at the end of it, instead of holding gold at a vault in your house, you can invest in tokenized gold that is vaulted somewhere, tied up to sensors and AI, to where it's verifying, it's auditing that vault constantly, and you can have access to say, hey, I actually own that gold. Instead of some certificate that's supposed to be redeemable for gold, or right now you have different assets, different companies say they have, you're investing in something, and you're getting some sort of digital representation that you own it, but where's the trust layer? The trust layer is that vault is still there. Anybody still think there's the amount of gold in Fort Knox that it should be there? No, right? So that's the thing with tokenized gold. The biggest thing with blockchain technology, and now you mesh that in with what you may call, has anybody heard the term DePIN before? DPIN, you know DPIN, what is it? Decentralized physical infrastructure network, physical devices. And that could be tied to sensors. So you can have these decentralized networks of sensors that are constantly feeding in. You know, there's probably going to be some AI data, AI tools to aggregate that data and audit it constantly. But you can verify at any point that what's supposed to be in that vault is in that vault. And so that's what's happened with tokenized gold. Equities, which are like your stocks and another thing, we're seeing that happen already. I mentioned real estate, trade finance. Trade finance, we're helping a specialty coffee company that's going to be, they're tokenizing the whole trade finance route for specialty coffee, because there's a lot of friction along the way. There's a lot of volatility along the way, because the spot price of, you know, of that coffee on the commodities market is very volatile. So by the time it leaves one place and gets to another, it could have changed drastically in value. If you can use tokenization to speed up settlement, some prepayments based on trust, then you can smooth that out. The farmers get paid a lot quicker, and so that whole process along the route, where it goes from the grower to the ones that dry it out, to the ones that ship it, to the ones that get it, they roast it, and then they distribute it to suppliers. So that's one thing that we're seeing quite a bit. Another deal we're working on with an oil company down in Guyana, South America, where the biggest friction point they have with doing business is on the trade finance side. When they want to issue purchase orders to vendors that are in or around Guyana, and if they don't have a U.S. bank account or some, you know, some model, whether it's U.S., U.K., or Europe, if they don't have a bank account from one of those areas, it's very, very much a friction point for them. And so we're going to basically utilize blockchain technology to where you're not only giving access to individuals, but multiple banks can participate. When things get competitive, that's when you see rates go down. And so these suppliers to ExxonMobil and other larger oil field entities down there will be able to take purchase orders from ExxonMobil and from other entities down there. It's a big conglomerate. It's not just one entity, and they're able to get the capital they need to deliver that purchase order, you know, to whoever's requesting it, and get paid quicker settlement times. You can tokenize insurance. We're seeing investment funds, private credit, infrastructure. A lot of renewable energy right now. I see, especially there's a couple of companies in Europe right now that we're working on using tokenization to help them fund some, basically some solar panels and other renewable infrastructure. Oil and gas itself is, you know, can be tokenized. The production, you're probably going to see, I mean, most of the larger oil conglomerates are very well funded, but there's a lot of smaller oil and gas companies that could utilize this to help fund their operation and grow their operation. Equipment and transport, there's a van lease company in the UK right now that we're talking about basically moving that whole van lease fleet. It's a huge fleet that they're going to be doing, and they're going to use tokenization to fund that. And then IP and royalties, and this one is still, I get the concept, but this one I had a call with a company last week that's tokenizing IP and the need to use our infrastructure. I'm still trying to wrap my head around that one, but it just, I guess at a high level, if you think about it, if you have certain IP and you want to make it accessible by others, you can basically fractionalize that ownership to where people that hold tokens may have access to utilize your IP while they hold it. So that one we're still trying to work through. I got a group that we're hashing that one out. So this is kind of redundant here, but you know, the issuer improvement, treasuries, automated distributions for the issuer and for the investor, 24/7 on-chain yield, and typically you can transfer them peer-to-peer. That's another thing about blockchain technology. That's what appealed to me about Bitcoin, is if I want to send something to you, nobody can get in the middle. Now, some of these tokens are going to have basically smart contracts programmed in to where if the asset to hold asset, you have to be a accredited investor. I can't send it to you until you verified on-chain that you are a accredited investor, and then it meets those requirements. The smart contract will allow it to be transferred to you. So you can program compliance in, and you can also make it to where you smooth out a lot of the friction. But going through all of these, private credit, bonds, commodities, real estate, you can see the improvements for the issuer, the improvements for the investor. And like I said, you'll hold a tokenized asset probably without even realizing it in the future. That's where we're going. That's the way it should be. That's the way this technology should be. We use a lot of these terms in crypto and blockchain that just the general public doesn't need to know about. Not saying that we have to hide it from them, but it shouldn't be those friction points. Think about NFTs. Anybody have ever heard the term NFTs? Tell me what you know about NFTs. Non-fungible token, right? Yeah, so, and that's what most people know it as. They think it's a JPEG on-chain in your wallet, right? That's what they think an NFT is. NFT has so much potential, especially in the tokenized space. Now, if you don't know the difference between fungible and non-fungible, fungible is where it doesn't matter, like each unit is exactly the same in value. So it doesn't matter if you give me a $100 bill and I give you a different $100 bill back, does that matter? No. But if you give me, say, a Mickey Mantle rookie card, and I give you, I don't know, some rookie from last year's card, is that fungible? No, right? And so that's what non-fungible means, is unique. So in the future, your single family home that you own, if that's represented by a token on a blockchain, that is an NFT, because it's non-fungible, it's a single unique unit, and that's what we're gonna see happens, but we're gonna stop using those terms. Because NFT, just like, if someone asks you what's an NFT and you say non-fungible token, if they don't know anything about what fungible and non-fungible is, you still haven't answered the question. And we're gonna see that happen. When the technology gets adopted, it's gonna be hidden behind the scenes. To where, how many people do you say today, if you're downloading a song, do you say you're downloading an MP3 still? No, right? That's, now, what was it, 10, 15 years ago? We would say that, we're downloading a song, I'm downloading an MP3. And we don't say that anymore because it's just a song. It's a song on chain. So whether that token is represented as an event ticket, or it's represented as a membership ticket, or a membership token, whatever it is, we're just gonna call it what it is instead of calling it an NFT. And that's what's gonna happen with a lot of these rails. And so when people are holding digitized assets that are on chain, they're not even gonna know it, because we're building out the tools to make it super easy. All right, so a little bit about Bluebird. I'll tell you about us. Bluebird, we are an end-to-end asset tokenization company. We're a white glove service. We work with issuers, we work with asset companies, and basically we just help them bring their assets on chain. We can help them connect to global marketplaces, global capital, just that whole technology infrastructure of what we do. We have built-in KYC AML into the platform for both the issuer and the investors. And we do registry, cap table management, and a secondary marketplace. We tokenize across 23 different sectors. I mentioned some of them today. There's just way too many to go through, because when you just look at the friction points in any business today, any business model, and the question should always be, if you're gonna say, I'm gonna use blockchain, why? How many people think over the last, say, 10 years, a lot of companies have put stuff on blockchain just because they thought it was cool or was gonna help them out? Anybody remember that tea company that did it back, what was it, 8 or 9 years ago? So there was this tea company, I think they were based out of New York. Do you remember this? Yeah, and they were publicly traded, and they added blockchain to their name, not even using any blockchain technology, and of course, their stock pumped, and then it dumped, and then people realized it was a scam. So, if you want to look at it, you want to say, what problems can this technology solve for me? Don't just do it as a marketing play. Don't just do it for hype because it seems like it's the latest thing. We're seeing the same thing happen with AI today, right? What problems can it really solve for you, your business, your customer, or anyone, your investor, anywhere, everybody in between? If there's reasons for that, then you want to utilize that technology. So if you got any questions, let's talk afterwards. Like I said, this PowerPoint's available if you like it. My email address is on here, Wayne@getbluebird.com. I always say we spelled it wrong, but there's some reason behind that I'm not sure why they picked that, but BLUBIRD, no E in the blue. Reach out to me or catch me here after this talk, and I'll be glad to share a lot more of what we're doing. There was even an hour today. I think this has to come in bits and pieces. This is it's a new concept for most people, and it takes a bit to understand really how this is going to work. And so even myself, so when I first started doing work with Bluebird, prior to that, I worked in the crypto infrastructure, layer 1, blockchain, and protocol side, where we're building tools to make things easier. And when I get into this thing, oh yeah, I know I've been studying blockchain for years. This is going to be simple. And I realized you really have to start understanding how all of these different industries operate. But if you're in a certain industry and you have a question if maybe tokenization could be right for you, get with us. We can help you figure that out, figure out what problems to solve, and not afraid to say it. There's been multiple companies I met with, and then I'm like, well, you don't need this yet, or you don't need this at all, right? This is not going to solve a major problem for you. Most of those concerns are typically where they think they're trying to raise funds for a company. They think, hey, if I tokenize this, I'll instantly have investors. That's not the case. So, all right. I guess we got time. Any questions? Yeah, Mike.
Okay, say you take a company that tokenizes a building and they got all these investors. Can that company go borrow money from the bank now that he sold all these tokens?
Yeah, if the company is the holder of typically that company would still be the SPV that holds the title to that company, right? So yeah,
So they can go borrow money now. Say if they fail to pay their note, whoever holds those tokens, what happens?
yeah, I see where you're going with that. Yeah, that definitely has to be. There still has to be some legal contracts off chain to
I think you got to.
legal protections. Yeah,
So I think, being a state senator and wanting to make laws to make sure nobody gets hurt.
yeah,
I'm just saying that, to me, if that's the case, a bank needs to check, and if it's tokenized, they gotta think twice whether to mortgage it or not, or those, see, because on a mortgage, if you got a mortgage on already, go get a second mortgage.
yeah,
The first mortgage is in control, no matter whether that bank did the second mortgage or not.
yeah.
Or the tokenizers ahead of the bank mortgage, or, that's my question.
Which ones are ahead of which, I'm not sure, but that's definitely something that has to be spelled out in the legal framework. Just like if they had that first mortgage, they have to disclose that. Yeah.
And that's where we're going with all of this, to make sure
Right.
that nobody gets hurt, and because I don't know that answer either.
Yeah. We should probably have Born in here. Yeah, so definitely, if you get into tokenization, I always tell her, don't get into this without having a good attorney that understands this, because the framework could be different depending on where you are in the world too. Yeah. Yeah, yeah. I'm doing that right now. There's a group that wants us to tokenize some charter yachts. And, there's some states that issue titles and there's other states that don't issue a title, right? So it just gets very complex. So those are those things we're trying to work through. And every time we have a deal come across, have to become an expert or find the experts that can tell us, what the. Yeah, yeah. Yeah, yeah, good point. Yeah.
So you mentioned a lot of like institutional finance, like the frictionless ability to, let's say, like get yield, right, or you don't necessarily need the RWA to trade the RWA, so you want to hold the RWA or the tokenize, the token itself because you have yield. And then the institutions are probably going to have still sort of be the middleman for this, if you really like think about it, right? All these big institutions are coming up, and I'm a a regular retail investor. I'm busy dealing with home matters and life in general, but I want to get exposure to this, and so I go to my broker, or I go to the BlackRock group, or the Fidelity, or the Franklin Templeton. And, it seemed that if I don't have the wallet, then that yield is kind of just going to the wallet that they control. Or the RWA token that I have is sort of behind the fence over at their office, right? Kind of like just a database. And then and another sort of thing along with that is, in the past when we wanted to buy tokens, we had to send Bitcoin or Ethereum in order to get another Ethereum-based token, right?
Yeah.
You could just go spend dollars from that bank account. I mean, maybe you can do that now. But these seem like, I don't know, I guess I was just thinking about it, right? If all my tokens are really being custodied by a third party, or if the products are being made by those companies, and the product and the wallet is being held by those companies, the yield is going to account, and it's still my wallet at that company. And I guess we still need a lot of laws about, can I take the wallet out of that company? Can I
Yeah.
key to that wallet? What do you think about stuff like that?
Well, yeah, you should definitely too. That's the way our technology is designed to where you can bring your own wallet, you can create your own non-custodial wallet, or you can have a wallet that's held by like some of our institutional wallet providers. And the biggest thing about that is what's the easiest for the client, the customer, whatever. Because I think it just take asset tokenization out the way and just say crypto in general. Like 10 years ago, I was telling my dad, like my dad was the only one in my family that got into Bitcoin with me. And, for a while there, I was, I was telling him about non-custodial wallets, not your keys, not your crypto, and then I realized that his biggest risk is not that. Like I've helped him set up guardrails and stuff, and I realized today, I said, look, just buy on Coinbase, leave it on Coinbase. Like the new stuff, the old stuff, I got it set up in a cold storage wallet, but I'm not having him send to that all the time because I realize that's best for him. The risk of him losing his own assets by making a mistake are higher than Coinbase going out of business. So it's really, you want to build it to where there's multiple rails, like where they can either self-custody or rely on institutional custody. Yeah. Because most people don't want to hold their own stuff. I mean, they don't want that risk. Yeah. Yes. Thank you. So for what type of, I didn't catch the position. What type of job? Oh, engineer, yeah, okay. Okay, that's fine. I thought you had said engineer, but I wasn't sure. Yeah, really, I mean, the information is out there. The thing about this is you want to learn as much as you can about the industry. And it's really just become, like, that's how I decided to shift careers 10 years ago to jump into this. And so for me, I became a student. Like I was learning as much as I can, getting involved in networking. And now we're at a point in time of adoption where there's a lot of events happening like this in multiple places, around the U.S. some are smaller, some are bigger, but really it doesn't really depend on the size, it's the people you meet. Networking is really the best way to get involved. So I could say, become an expert in what you do, and that's great. And you definitely want to learn as much as you can, but find those people that know what you want to know or are already doing what you want to do, and network with those people. Especially like, younger people. I tell people all the time, like interview them, like start a podcast and start interviewing people that you look up to in business, and you'll learn things. But just build that network. That's the most important thing I say is get out, network with people. Find out where, who's doing that job. If there's someone you can connect and job shadow, that's something you could do. But a lot of skills are also transferable, and it's really just learning a little bit more about the blockchain side, and maybe you already have certain skills that are transferable from a prior career into that job. Definitely knowledge, become a student, definitely pay attention to what's happening, start learning because it's changing so fast. I put out a beginner's guide book on Bitcoin and crypto in 2018, and over the next few years, I've probably edited that thing like 10 times because it kept changing. So it's less about what you know if you have the ability to learn as you go, but also, building a network and connecting with people, find out, who's doing it, look at who's talking at events like this and others, and try to connect with those people, either in person, online. We're probably in a point of the world today where we haven't, we've never been more connected than we are today. So you can definitely connect with the right people.